Thank you, everyone, for being here today. As David mentioned, my name is Madeline Hume. I'm an associate director in the research group here at AlphaCore. And also, as he mentioned, income is one of the #1 questions that we hear from our clients. How do we generate income, and how do we keep more of it after taxes? Since 2022, generating income has gotten both easier, but also more difficult. Easier because we can earn elevated nominal rates on cash for the first time in a very long time. But more difficult because maintaining that purchasing power after accounting for inflation is a real challenge. I'd like to start off with a question for the audience, if you guys don't mind. Does anybody happen to know how much money sits in money market assets today? Anyone? No? Any guesses? 6 trillion, 7 trillion? I thought you guys would be good at this. So it's actually $7.5 trillion as of Q2 2025, which is an all-time high. And the first slide that I'm going to walk through today hopefully shows why that is. My esteemed panelists are on the screen right now. So what we've got here is 3 different lines. These 3 different lines represent 3 different maturities of different bonds or fixed income securities. The first one that I'd like to call your attention to is the blue. That's the shortest duration fixed income instrument here. It's effectively overnight. It's the federal funds effective rate. This is what money markets are priced off of. This is how cash earns yield. We've also got a red line, which represents the 2-year treasury yield, so a little bit longer duration fixed income instrument. And then we have the yellow line, which is the 10-year. In normal market environments, what we typically expect to see is those red and yellow lines out-yielding the blue line. But what happened starting in July of 2023, when the Federal Reserve ended their hiking cycle, is that cash has actually out-yielded these longer duration fixed income instruments. So sitting in cash has worked out great, right? Except you can see that starting in September of 2024, when the Federal Reserve cut interest rates for the first time, that advantage that cash had started to wane. We expect it to continue to wane, as augured by the most recent Federal Reserve interest rate cut on September 17th. And market forecasters estimate that there's an additional 1 percentage point of interest rate cuts coming over the 4th quarter of 2025 and into 2026. This is a real challenge for fixed income and real estate managers who are trying to generate income, especially when you think about the impact of inflation. And this next image that I'm going to show you kind of goes through why. So it's a little busy. I'm sorry, you don't have to see all of the numbers on here to understand exactly what's going on, but we've got 2 primary lines. The first line in blue is the nominal yield on a fixed income security. That's just the stated interest rate, how much it's paying out. But we've also got the gray line, and that is the real yield of that same fixed income instrument, which means that we deduct the impact of inflation. What you can see is that in most market environments, the real yield is positive. But starting after the inflationary bout that we witnessed in 2022, yields turn negative after accounting for the impact of inflation. For anybody that's at retirement or near retirement who's trying to generate income, this condition is absolutely critical to keep an eye on. And when we think about the future for inflation, as my colleague David mentioned, it's really a question of, can we generate income the same way going forward as we could in the past? And the stance here at AlphaCore is that we cannot. We have to adapt our philosophies for short-term interest rates falling and for inflation to be part of our environment. Luckily, we're joined on stage by my 3 esteemed panelists who are going to walk through some of the strategies for how we generate income and meet the unique challenges of this dynamic. One way is through winning more by losing less, a strategy where we incorporate uncorrelated return streams to hopefully reduce the impact of different market environments by building resilience into the portfolio. On stage here we have Michael Cerami from Artisan Partners, who's going to walk through the unique strategies that he uses in his portfolios to hedge against uncompensated risk factors to be more defensive in periods when markets struggle. The other way to do it is to be smart about the tax profile of those investments, leaving, hopefully, investors with more of the income after accounting for the tax profile of our investments. My other 2 panelists are going to walk through some of the strategies for that. But let's introduce them, right? So on the end is Gary Rozier. Gary Rozier is a senior managing director at Blue Owl. He is responsible for investments across the firm's real assets group, with whom we partner on real estate strategies in the triple net lease segment of the market. We'll explain what that is, don't worry. He is also a member of the firm's investment team, and he sits on Blue Owl's investment committee. Next to him is Michael Sarami, as previously mentioned. Michael is a managing director at Artisan Partners, where he is a lead portfolio manager for the firm's EM Sites group. He, prior to joining Artisan Partners in 2021, spent several decades of his career at Eaton Vance as a co-head of their emerging markets group. He's a recent joiner to the AlphaCore investment menu. We've been working with Michael just since this year, and we've already been really impressed with his insights on the space. Finally, we have David Hammer. David is a managing director at PIMCO. He is in charge of municipal portfolio management across several sectors of the market. So we've got taxable municipals, we've got investment grade municipals, high yield, and then SMAs. And AlphaCore works with PIMCO on a variety of these strategies. So everybody, if we could give a round of applause for these gentlemen, and we'll get started with our conversation. All right, so very excited to have all of you gentlemen here today. I think it's important to acknowledge up front that each of your strategies presents really unique characteristics, and I could probably give each one of you the floor for about 10 minutes of a 30-minute panel, and by the end of that, we'd get some idea of how your strategy works. I'd like, I think, to start in a different place instead and walk through a story, building on this theme of winning more by losing less, and talk about a time when your particular market was going through a period of stress or contraction, and how the portfolio design that's embedded into how you manage money helped to build resilience during that period. So maybe David, starting with you, we've been talking about 2022 a lot. It was a very interesting environment to be managing money through. So I'd love to hear kind of your perspective and how you managed through that really volatile time.
Yeah, well, great. Thanks so much for having me today. 2022 in my market, the municipal bond market, it was the biggest drawdown period ever. So simple indices were down 15%. The biggest outflow cycle ever, about $150 billion of retail investors took their money out as interest rates rose sharply. And the impact of this event, it is more significant today than it used to be in the muni market because of declining liquidity. You hear a lot about banks pulling back from various spaces. The muni market's particularly bad because Dodd-Frank and regulation, it increased the cost of capital for banks to hold muni bonds on their balance sheet, so they hold less to make markets. Also recently, the corporate tax rate going lower means that this type of debt, it's less attractive tax-exempt income for banks than it used to be in a 21% tax bracket. So when 2022 occurred, this sharp outflow cycle, it put really extreme pressure on prices because the traditional providers of liquidity, banks, they're not there to step in anymore. Now, this is something that we saw coming at PIMCO about a decade ago, and we launched a number of strategies really to take advantage of this dislocation. The interval fund structure is one that we've partnered with the AlphaCore team on in particular. What's unique about it is instead of a lot of the strategies that we manage that are ETFs or open-end funds that are subject to daily liquidity, so we get outflows from those as well, and we have to manage liquidity. This vehicle, it's quarterly liquidity, so our clients are not subject to the same price pressures due to outflows from the market. It allows us to step into the market and be a buyer. So in 2022, it was a very fun strategy to manage for our team. What we do in that environment, we draw down on lines that we have against the fund. We borrow from banks. We step into the market, and it sounds actually pretty simple, but we're one of the few buyers when ETFs, open-end funds, traditional retail investors are selling. In that year, it was less about some of the private credit that we source. It was much more so just being a liquidity provider for a lot of people that had to sell bonds at distressed prices. Some of our best performing bonds that year were things like AAA rated Yale University bonds, where we just had capital when others didn't.
And so Gary, the theme here is back to the future, so we're going to go back to the past a little bit and deduct just 2 years from that environment. Can you maybe talk about the unique environment of COVID for real estate managers? A lot of people during that time rethinking even the utility of real estate across a couple of different sectors, and maybe we can go through what triple net lease is and how that varies relative to core real estate and how you manage through that period.
Yeah, happy to. That was a period of time, I think, in recent history that we all, experienced. It's one thing to talk about periods of time where maybe we weren't in the market, but I think we all lived through COVID, so everybody knows what that was like. Our strategies you mentioned before within real estate, yes, we buy hard assets, but we think of ourselves much more as a corporate finance partner to companies where we're going to them basically saying, you have a great operating business that does something that's not real estate, so we think you have a better use of those assets than to have it tied up in a hard asset. So we really present ourselves as another form of capital for those companies. We do that in a unique way, though. One, when we buy assets, we structure it to be net lease, and you guys have heard me say this before, but it basically just means our tenants are responsible for all the operating expenses. So they have to pay us our rent net of all expenses, right? So it really kind of mitigates your expense risk, but it's also a great inflation hedge. So then on top of that, we only work with investment grade rated companies, right? So our perspective is we want a great company that's on the hook for that lease, and then we want to be in an asset that's mission critical to their operation. So giving you all this background, just so you kind of understand all of the risk mitigation that we do first. But you think about COVID, what companies didn't know was what their future cash flows looked like. A lot of companies were shut down. Many companies wanted increased liquidity on the balance sheet just to kind of navigate through. So unlike a lot of our peers in real estate who stopped buying real estate, we were actually on the gas pedal going to these companies and saying, well, we can provide you liquidity or provide you capital through the monetization of this asset you already own, right? It's just sitting on your balance sheet, you get no credit for it. Then we're going to lease it right back to you. So there's no change in your operation at all. You stay in the asset, you continue to manage the asset, but you also pay all the operating expenses, which by the way, you already are because you own the asset. So I'm not giving you a new expense. But now you have the value of this asset in your hand today that will help you navigate through this period. So you're going to have increased liquidity. There were companies that were forward thinking and saying, what a great time for us to grow. So they were using our capital as growth capital, so they were growing their footprint. So for us, that period of time was, I'd say very opportunistic where we were a very, very large buyer of assets. So in year 20 and year 21, we were the second largest buyer of commercial real estate in North America behind Blackstone, and we had 25 people on our team. So we were really on the gas pedal there. Most important thing though, because we do have great tenants and we have these great leases that mitigate the expense side of the equation, and we're in an asset that they need, we collected 100% of all rents every single month from every single tenant through that COVID period. I think we're still the only PE real estate firm that can say that. And again, while very proud of that, our strategy set up to do it. So we also weren't surprised by it, right? That's why you put all those risk mitigation factors in place. So when you get to a difficult period, A, we're preserving your yield. Again, we pay that every single month, but we also can be opportunistic.
And so maybe to help the audience put some faces to names, when you talk about the tenants that you have these relationships with, who are the counterparties that you're working with?
Yeah, I would say our tenants live inside your house. They're places that you frequent. So most of them are, publicly traded Fortune 1000 global national companies like an Oracle or an Intel, Starbucks, 7-Eleven, BP, Chevron. Again, these are household names. These are companies that you expect to be around the length of our lease. And these are companies you expect to live up to their responsibility of paying rent and paying all the expenses, but also growing as an organization. And that's really important to us to make sure our counterparty risk is extremely strong. So you can think of the biggest, most prestigious companies anywhere in the world, that's who occupies our buildings.
Well, anybody that went to the AlphaCore offices last night probably saw more than a few Starbucks cups laying around. Having one of those in the building is pretty dangerous, so very cool. And so Michael, maybe transitioning to you and going a little bit further afield from the Starbucks cups in your office, I'm curious, emerging markets debt has gone through a variety of different really idiosyncratic events, and it seems each story is very linked to a particular market. So can you talk about just the activity within EM debt and how it moves in dialogue with broader fixed income markets, or how it doesn't?
Yeah, no, well, thank you for having me. And crises and market dislocations is a part and parcel for the landscape in emerging market debt. And I think that's a good thing. It keeps people away off it. They see the volatility, they see headlines in the news, and it creates some distance between investors and the assets, which we like. But I think what's missed is that there's a very broad universe for emerging market debt, both geographically and with the asset types. So you have local debt, you have external debt, you have corporate debt, you have sovereign debt. So it's a very kind of rich landscape. And I think like for a flexible investor like us, which we invest both on the long side and on the short side, the volatility that we see in the markets, whether it's generalized from maybe something coming from the US, like the Fed and interest rate changes, or maybe global oil markets, which will impact emerging markets. So these kind of generalized risk-on, risk-off events or shocks, or something specific to an individual country, maybe like we're seeing most recently in Argentina, as there's been some political bumps in the road. These sort of events create opportunities for the flexible investor who can allocate cash across a very broad opportunity set. So our job is to sort of navigate through these events, stay away from markets when they seem fully valued, allocate to countries maybe that just went through a major or mini crisis, or just happens to hit a new a new political cycle where things are going to move in a more positive direction. And I think that's how you capture the value and the income opportunities that perpetually exist within the emerging market debt space.
Great. And maybe, Michael, we can spend just a second too talking about how you may neutralize some of those uncorrelated or uncompensated risk factors that you don't necessarily want to introduce to the strategy.
Yeah, so the ability to have flexibility that includes shorting really kind of opens up a lot of different possibilities. So for instance, if you look at emerging market debt in the dollar space, and if you're familiar with the US high yield market, it's similar to that. It's a spread product. It's incremental interest over the US Treasury curve. And we can hedge out the US interest rate risk. So if we're going to lend money to a country like Mexico or Brazil or Bahamas, we're going to short US Treasuries in conjunction with that, so that we leave aside the volatility, good and bad, that comes with the US Treasury market, and we could pinpoint the emerging market risk factors that we're analyzing as an investment team. And the importance of doing it this way is really critical, because when you strip out those concentrated risks like the US Treasury curve, or maybe oil, which kind of permeates through a lot of different EM type of assets, and you could hedge out oil by being short some oil type of names, you're left with a much better diversified basket of emerging market assets. And that's what's often missed when you look at the asset class from a bit of a distance, or you perceive it through the prism of the benchmarks, which are just unable to do that. And you get these exogenous factors that often lie outside of the EM debt space that's really whipping around the asset class and creating this lack of interest in it, which leaves excess risk premium for those that are willing to take a look.
So maybe shifting gears a little bit, but staying on this topic of flexibility. Yeah. I have the pleasure of speaking with each one of you on a regular basis, maybe when the lights aren't shining quite so brightly on your asset class. When market participants' interests are turned elsewhere towards what's going on with the Mag 7 or maybe the latest tariff announcements coming out of the White House. And these are the periods I find where consistent income and incremental alpha is generated in each one of your strategies. So I'm curious how you each go about doing that, and pulling back on this thread of flexibility. David, maybe we'll talk with you a little bit about what your team is looking at perhaps today, and what securities are interesting to you, and how they might incorporate different elements that make a market participant maybe not quite so sure how to place it.
I think there's a lot of talk in today's markets about public versus private. And at PIMCO, we think our edge is that we see this as a continuum of risk. So we're able to pivot in our strategies and do both public debt and private debt. And in 2022, when there was a massive market sell-off, the best opportunities were in plain vanilla public market bonds that were being marked to market. It's a different story today, and we're doing more and more in our private origination sourcing pipeline, risk that ultimately lands in these vehicles. Our favorite opportunity right now is affordable housing in the United States. The way most affordable housing is built, it's through a federal program called the Low Income Housing Tax Credit Equity Program. It's a big acronym. But the way it works, basically the federal government allocates tax credit equity to incentivize the development of these projects. It's really valuable to developers. It's worth about 35% of the project build cost. So if there was a $100 million new project being built here in La Jolla, a developer might get about a $35 million award of this tax credit equity. They turn around and they sell it to a corporation that's buying down their tax liabilities. So these are big, deep-pocketed investors like JP Morgan, Berkshire Hathaway. The senior part of the capital structure, they're able to borrow in tax-exempt municipal bonds. Now, these tend to be pretty small deals, or $25 to $50 million. They're not rated by agencies. And in order to source them, you have to partner directly with real estate developers themselves. So we put a team together at PIMCO. It's a combination of our muni team, our real estate origination team. And we built a direct lending product where we're now doing about $2 billion a year in annual origination. Why do we like this stuff so much? It's a lot of income that's also tax-free. And the risks are very low. With equity markets at all-time highs, corporate bond spreads at all-time tights, we spend a lot of time worrying about what could go wrong. And in these assets, default rates are about 30 basis points a year. So that would be equivalent with like a AA-rated muni bond, going all the way back to 2000 through the financial crisis. So a lot of excess yield, difficult to source, which is one of the reasons yields are so high, but also really well protected if times get rockier, which we think they probably will from here.
Very cool. Well, hopefully we can come back to that in a little bit. But maybe, Gary, turning it over to you and talking about the advantages of sourcing and working on deals with individual potential tenants. How do you think about putting together the portfolio? And maybe we can talk about putting together a portfolio from scratch and some of the advantages of doing so in this current market environment.
Yeah, I'd say we try to avoid anything that's overly prescriptive or top down. Our perspective is we always want to be nimble enough and opportunistic to go to where we think we can get the best risk reward for your dollar. And interestingly, in real estate, that changes fairly often. I think of the sectors that we've been heaviest in over various vintages, it almost always changes. Like every new fund, it's always a different sector where we're spending most of our time. And again, it's just reflective of us going to where the opportunity set is. But as we think about how we build that, it's much more, where is the need for capital greatest? And if we're a partner to these corporations, we're kind of agnostic as to where it is, location-wise, geography-wise. To us, it doesn't really much matter. It's what does the corporation need and where can we get the best dollar? I know that's a pretty broad answer. Let me drill down a little bit. You take today, for example, everybody's talking about data centers, and I hate to be another person to add to it, but that's where the greatest need for capital is. So our play there is not to be part of the gold rush, it's to be selling picks and shovels, right? So our perspective is we're happy to provide capital to help you build these things, and we'll own them in exchange for a long duration lease where you're going to pay us income for 15 years, right? But the point is I don't have to be right. I mean, I don't have to find the gold. We're just providing the picks and shovels to whoever's going to go out and do that. But that happens to be by far and away the best risk reward trade-off today. So what I am not saying to you is I'm smart enough to know where the future of AI is going, and I'm going to go buy a bunch of land and figure out power and figure out entitlements. It's like that's not the point at all. I know there are some hyperscalers that are spending several $100 billion, upwards of $1 trillion, where they need capital. That's where we want to be. So that's how we think about sectors and being opportunistic. Again, that changes over time. It's always best to not take a top-down approach, but be nimble and say, well, where are people willing to give you the best price for your dollar? So that's how we think about building our portfolios, and I hate to ever go in and say, here's what I think it's going to look like. My answer is always, I have no idea, but what I can tell you is I'm going to find where the risk reward is greatest, and that's where we're going to buy our assets, or partners that we're going to work with, from a sector perspective or from an industry perspective. So again, for us, it's all about being opportunistic and very, very nimble.
And Gary, if we could stay on you for just a second, I promised the audience we'd talk about tax benefits. So when you're working on delivering from these lease payments into a consistent income stream, what are some of the characteristics of real estate that can help improve that after-tax profile?
Yeah, I mean, the beauty is most of what we're doing is structured as a REIT, and we have beautiful REIT laws in this country where we can effectively depreciate assets down. And could you maybe explain what a REIT is? Yeah, sorry, real estate investment trust. It's basically a structure of a vehicle that you would buy real estate assets and put them into this trust. And again, there's laws that govern what you can put in there, how long you can hold the assets, but in exchange for that, you get some great tax benefits. One of those is that we can pass along to our investors is something called return of capital. So as we pay our yield every single month to our investors from the income that comes from those assets, the majority of that can be categorized as return of capital, which means you as investors can defer that tax payment. That means you're taking that actually in your pocket. So tax equivalent yield to a bond, sorry, David, you would need something like 10, 11% to be equivalent to our after-tax 7 or 8% yield, just because, again, it's not fully taxable. So that's really the advantage. Nothing special that we're doing necessarily. It's just the way that the REIT laws are structured. So we make sure that our funds are structured that way as well, so we can pass along that tax benefit to our investors.
Great. So Michael, time flies when you're having fun with your friends. I think we might land the plane with you and then turn it over to audience Q&A. So we've talked about some of the ways that portfolio construction can be utilized to help ensure the portfolio in resilient environments, but sometimes there are things that are completely out of our control. And a way that I'd like to bring that to life is through international versus US stocks. So many people might be aware international stocks are outperforming the US year to date by about 12 percentage points. But what may not be quite so obvious is that a decent chunk of that is due to currency moves, and specifically the depreciation of the US dollar relative to other currencies. Once you take out that impact, the benefit of US or international versus US gets reduced to about 4.5 percentage points, so very meaningful. Michael, many people think that if the dollar's depreciating, that they should be reallocating to asset classes like gold and Bitcoin to help protect against that. But this example just kind of goes to show how it can impact a variety of different strategies in really unique ways. I'm curious how currency fluctuations impact the way that you manage money and how you think about it, and how you might be able to actually be positioned to benefit from some of these fluctuations.
Yeah, so I mentioned earlier about the broad kind of universe within the emerging market debt space, and a good 50, 60, 70% of it, depends on how you want to count, is actually foreign currencies and foreign currency debt. So it's a huge segment of the emerging market debt space. And so, you know, this idea of like the dollar is going to be strong, the dollar is going to be weak, and views around that are critical for some managers. Our approach, you know, we try to be a little bit more agnostic. It's really hard to predict, you know, strong dollar, weak dollar. It ties itself back to the Fed, I think, and U.S. policy, which sits outside the EM debt asset class, I would say, for the type of analysis that we would like to do. However, you know, the broad environment is part of the opportunity set. We can shift towards EM currencies. Some have very high beta compared to how the dollar, maybe not as high as gold.
Sorry, can you explain what beta is?
Think about the co-movement of one asset versus another. So if the dollar is going to depreciate by, let's say, 1% versus a basket of, we'll just stick with currencies, EM currencies, some of those currencies might appreciate, or the dollar might depreciate 2% or 3%. So just have a lot more gearing or kind of leverage around a particular movement. So, so we could navigate through this environment of highly volatile EM FX and then low volatility EM FX as just part of the opportunity set. So for us in like our portfolio this year, we've actually been more tilted towards dollar strength. I think we got that wrong, and it pivoted the portfolio as a reflection of maybe, you know, we need a little bit more balance around that particular issue.
Yeah, well, humility is important in markets for sure.
You don't always get things right, and you need to position for that. So.
Well, cool. Thank you, everybody, so much for your time. I'm curious if we've got any questions in the audience. We've got time for one or two. Anyone? Sure? Yeah, absolutely.
We keep hearing a buzz these days about how the multi-billionaires are taking money out of their portfolios tax-free, especially if you have companies. Can you elaborate?
So I think the question to the panelists is, you know, individual tax profiles at the upper end of the market, some strategies that are utilized by those folks. Maybe within the scope of this presentation today, we'll talk about maybe the tax advantages that these strategies present, because they are utilized by a variety, if I'm getting it right.
Let me put it here. Can
Sure.
I borrow from myself?
Sure.
The interest I pay is tax-free, but the interest I take is tax-free, while the interest I pay is tax-deductible.
So I'd be happy to take a shot at that. Just because we work with a lot of you know, ultra wealthy clients that are allocated in big ways to the muni market, and some of them will invest in tax advanced strategies with dollars that they've otherwise borrowed somewhere else. So it's, you know, depending what you borrow against and your interest rate, I think that's independent. But yeah, just simply looking at the strategy we mentioned in the tax-free space over the last 3 years, you've earned about 6.5% tax-free in a, you know, relatively high credit quality portfolio. So I think getting your income down is a pretty standard strategy at some of the upper ends of the tax range.
Excellent. All right, well, I hate to leave it there, but we are getting the big red button, so really appreciate everybody's time. I'll turn it back over to David, and we'll get on with our programming today. Thank you, everybody.